Welcome to the blog 2, Investing in Common Stocks. In this sections we are talking about the common stock dividends, types of dividends, and the reinvestment plans in form of dividends. So the topic 3, common stock dividends. Dividends income is one of the two basic sources which investors from a stock can get. One is the capital gain, the other ones are the returns out of the income, the net profit that the company is earning, and this will be provided to the shareholders in form of dividends. Compared to capital gains, dividends are certainly more predictable, because a company which issues dividends needs to follow this policy, which we call very often the dividend policy. Capital gain is not as much predictable because the profits are not as predictable, but the dividends supposed to be or should be predictable for an investor. What the taxes concerns nowadays, dividends and the capital gains having the same tax issues, so there is no disadvantage or advantage against the capital gains. We discussed on which basis does management or the stockholders in form of the owners are deciding whether there should be dividend payments or not. We have seen that Netflix is not paying dividend, but not paying dividend does not mean that the company is doing bad. Maybe the other side is correct. So the board of directors normally evaluates then the business and the financial situation of the company and makes then a recommendation to the shareholders whether dividends should be paid out and how much dividends should be paid out. For that, there are a couple of factors important. One is certainly from the corporate side, the earnings per share. The earnings per share is calculated by the net profit after taxes, which we know, net income, net profit from the income statement. Then we need to deduct from that the dividends paid to the preferred stockholders, because they are preferred, they're getting the dividends before, and that will be divided by the numbers of shares outstanding to the common stockholders. We have seen with Netflix that these earnings per shares are $11 roughly. So they could pay out dividends because they are profitable, but the board of the directors evaluated the firm's operation results and the financial situations to be not the right time to pay dividends, especially they might have better investment opportunities. And that's something which is another corporate factor for the decision to pay dividends, the growth perspective. If the company needs still these earnings to invest this in future growth, in the case of Netflix, it would be to buying more rights on films, on movies, to create more movies which they can offer then over the platform. In this way, they believing that they can much more money out of that than providing this money to the shareholders. Now, in this case, management basically says, let us invest the profits which we earn into our companies rather than paying a dividend. Another reason certainly is cash situation. The management always has to consider that any dividend payments leads to cash outflow and that it's not hurting at the end the cash situation of the company. So, loan agreements. The lenders may have some covenants or some regulations in the loan agreements that limits the dividend payments to the management. Financial risk is here the situation. If the loan providers, the lenders, want to avoid that the company becomes more risky, then they are blocking some dividend payments because they believe this cash from the net income supposed to be paid to the lenders. Then we have market factors. The market factors are, do the investors are expecting a dividend yield or dividend payment, or do the lenders are more growth investors, meaning that they are believing more in the capital gain potential of the company rather than in a regular income. In this way, we're having the situation that we have more conservative investors expecting a dividend because they want to have the regular income. And we have more growth or more risk investors, which believing that the capital gain is more important than a current income. Growth investors are investing in these companies which are paying a dividend. So regular income or conservative investors are investing in companies with current income. Growth investors are more in companies like Netflix, which are paying no dividend but are growing fast. Now, what kind of dividends are paid and what are the dates? First, talking about the dates. Dividend has to be declared by the management and normally approved by the annual meeting. Once it is declared, then we're having this date of record. And this date means at that time, any investor must be registered as a shareholder of the company to be entitled to the dividend. So if I purchase the share 1 day after the date of record, I'm not entitled. If I purchase a share day before or at the day of the record, then I'm entitled to the dividend. Then certainly we have the payment date. That basically is the day where the corporation then pays the dividends. The earlier years in the United States is done by a check. The checks will be then sent to the shareholders. Nowadays, this is certainly done mostly by electronic transfer. Then we have an ex-dividend date. Due to the fact that the dividends are part of the equity, because these are part of the profits, the price on the market needs to be adjusted. The stock price reflects basically the overall equity part of the company. So if we pay some out of the equity in form of dividends, it has to be adjusted also on the stock price. This adjustment is done on the ex-dividend date, so the stock will be traded ex-dividend. Let's assume Netflix pays $10 dividend per share and it's traded $660 on the ex-dividend. Then the ex-dividend price would be $650 on the ex-dividend date. When we look on the calendar, dividend decisions, we see here that the declaration date when the management says we are paying dividend and the telling how much the amount of the dividend will be, then it takes another 2 weeks until the ex-dividend date is. Then 1 day later, the date of record has been, and the payment date is another roughly 2 weeks later. So these are the most important dates. We have in general two major types of dividends. Cash dividends means at the end the dividend will be paid out in form of money, and then certainly the stock dividends. In this case, the company pays to the shareholders the dividends in form of additional stocks. The stock dividend is very seldom happens sometimes with a spin-off, that the company basically spins off a division from the company. The most common dividend is the cash dividend. Now let's have a look on the dividend policy of Apple. We're going here to a website which is called Morningstar, which gives or provides quite a unique information about stocks. And we look on the last 12 years of the financials of Apple. We see here, for example, the revenues. We see here the net income the company had. We see here the earnings per share. And we see the dividends per share. Interesting is that Apple paid or started to pay dividends in 2012. And as you can see, they paid quite low dividends, 9 cents on a share. But they started to increase it already in 2013. And since then, the dividends per share are constantly increasing. An important part would be also the payout ratio. The payout ratio tells us how much of the earnings per share are paid out in form of dividends. And as you can see, this is in the area of 25% and is now decreasing due to the pandemic 2021. But Apple probably will increase these payout to 20 to 25% on the earnings later on. Good. There are another calculations which are important what the dividend yield, what the dividend payments concerns. One is the dividend yield. The dividend yield is nothing else than the dividend per share which I received divided by the current market price per share. And that's the dividend yield. When we may have a look again to Apple, and when we're getting now, here's a quote similar to that what we have seen on Yahoo. There is a dividend yield. You see the current forward dividend yield, meaning the dividend which is declared on the current price, is 0.54%. The dividend divided by the price. You can see it's not that high. There are companies having a dividend yield which is 3-4%. 0.5% is certainly not a high dividend yield. The dividend payout ratio I already explained on the example with Apple on Morningstar. It is the dividends which are paid per share divided by the earnings per share. So how much from the earnings per share will be paid out in form of dividends in percentage. And here the companies most of the time have a clear policy. Mostly they keep this payout ratio constant, though they try to have it in the area, as we've seen with Apple, in 25%. Only if there are certain events on the market, in this case the pandemic, may lead to a decrease of this payout ratio. It could also be that they're constantly increasing the payout ratio because the earnings strength is quite good. Now, what is certainly offered then for many companies and mutual funds is a so-called dividend reinvestment plan. As the name says, the dividends which are normally paid to the shareholders will be not paid in form of cash, rather than will be automatically reinvestment in additional shares. Please, this is not a stock dividend, this is a cash dividend which will be reinvested into additional shares. Offered by many companies and mutual funds, this is a convenient way of saying, okay, as long as I believe in the growth perspective of a company, I'm going to increase my stake in the company and reinvest it. dividends into the company. How is the effect on this? Let's look on an example. We buy 100 shares for $21, which the beginning is an investment of $2,500. The stock currently pays $1 per share as an annual dividend. The price of the stock is considered to increase by 8% per year. The dividends grow by 5% per year. Now, when we compare the two possible alternatives, one side we are getting the cash dividend paid out and we do not reinvest it, or the second alternative, the cash dividend will be reinvested into new stocks. Comparing this over a 20-year investment period, we see after 5 years the stock is worth, or the stocks are worth 3,672. Together with that, we have 552 dividends received. All together, our total amount which we have is 4,130 something. After 20 years, the stock price rose to 11,652. That's the market value. And we received 3,307 dividends. So altogether we have 14,959 worth of money. On the reinvestment plan, we do reinvest. We do not have any cash dividends received. So altogether, the numbers of shares which we having are rising from 115 to 176 shares. The total value is then 20,508. So there is a considerable big difference between receiving cash and using the money somewhere else or reinvesting the cash. The difference at the end is roughly 5,500.